Hi there, welcome to Grain TV. I'm Kevin McNew. It's Tuesday, February 14th, and a down day in the markets. Let's take a look at Grain Edge's trading platform and see where we closed. In Chicago, corn giving up a penny and a quarter on front month March, and beans losing 8 3/4, while wheat in Chicago off 2.5 below 450 after yesterday's strong advance. News today was kind of light. There was some flash sales announcements from USDA. Let's start first with those. First, USDA said they had a 229,000 metric ton sale of corn to Japan and a 142,000 metric ton sale of soybeans to Mexico, which was a somewhat surprising situation since we normally sell most of our beans to China. But nonetheless, it did little to sort of stem the tide. We've had a nice run up in corn and wheat in particular in the last week. And, really today just felt sort of like a risk-off day as traders sort of took the market down. Looking to the South America situation, Brazil is off to a relatively fast start in Mato Grosso, although they have had some recent rains that have slowed the progress there. But there is some concerns about lingering wetness and how that's going to affect not only the quality but potential yields out of Mato Grosso. They're about near the midpoint mark for harvest in that Brazilian state. Paraná is well behind pace for their harvest situation, and more importantly maybe, they are well behind pace for planting their second season safrinha crop. They're only 15% planted on that second season corn crop versus normally about 40 to 50% for this time of year. So weather still playing an issue down there, not out of the woods yet in terms of their production. So, that'll be something to watch in the coming week. Looking ahead to tomorrow, NOPA crush numbers for the U.S. will be released for January. Traders look for an average of about 159 million bushels to have been crushed in January. Keep in mind that the last 2 months, analysts have overestimated crush numbers by about 2 million bushels. So we'll see if they keep that in tow this month. Watch for that report around 11 a.m. Central Time as a potential market mover. Speaking of soy crush, let's take a look at some situations going on in China. And one of the big drivers of the Chinese soybean import situation is what's going on in the hog sector. China is a massive consumer of pork, and that is their number one meat that they do consume. And so what happens in their hog margins has a dramatic impact on how many soybeans they decide to buy from the world market. If we look at Chinese hog margins, first of all, this chart is a seasonal chart starting in the U.S. marketing year from September to August. In black, you have last year's margin. In green, you have this year's margin, and in yellow, you have the margin for the 3-year average before then. So what I want you to focus on, first of all, if we think about the rally that got soybeans moving higher last year, it really got hold in March, but started slowly back in January. And that January time period was the low in the Chinese hog margin in black, accelerating all the way into the summer. And hog margins in China just exploded over that time period and then quickly backed off as the later part of the season. This year we've seen hog margins really strong, seasonally strong, up until the last few weeks, and we talked about this a few weeks ago when it seemed like the hog margin was peaking, and it has indeed started to stair-step down. Now, what concerns me about this is two things. One, seasonally, if you look at the long-term seasonal trend here by the yellow line, we're entering a period of weaker margins. We've gotten past the Chinese New Year. All the sort of demand side factors are starting to wane a little bit for hog margins. So seasonally, we would expect hog margins in China to decelerate. Also, we still have a hog margin that is well above historical norms. So if we have not only a seasonal trend for lower, but we have a trend that suggests we need to return to sort of a more normal long-run lower margin, then that could spell problems in the second half of our season for exports. Obviously, we're going to face stiff competition from South America, but now if you add into that a weakness in the Chinese import demand, then that could be problematic as well. On the other side of the spectrum, the other indicator to maybe watch is the soybean crushing margin in China. That too has turned negative. If we looked at this next chart, the soybean margin this marketing year is in green. You can see it really skyrocketed high in December, and that really was a catalyst for driving soybean prices in the U.S. higher. But that margin, that soy crushing margin, has gone down to zero, dipped a little bit below zero and turned higher, but I wouldn't expect it to rebound sharply if hog margins are going to continue to weaken. So overall, this looks like a very sort of negative driver for the next 6 months in terms of Chinese demand. If their hog margins are decelerating, if their crush margins for soybeans are also well below where they were 2 months ago, then the overall appetite they may have for U.S. beans as well as Brazilian beans may start to erode. So keep that in mind as you're making your own marketing decisions. Obviously, we've got still weather left in South America to worry about and the growing season in the U.S., but with prices still on new crop beans well above $10 in the $10.20 range, I think it's probably a good time to get serious about doing some pricing. If we look at the long run daily chart from Grain Edge's trading platform on November beans, we can see we've been on this uptrend all the way back to August 1st. And right now, sort of the underlying support on this uptrend is right around 10.02. Overhead, we've touched on 10.34 two different times in the last month. One as recently as 3 sessions ago, and then a couple weeks before that. So 10.34 is sort of the upside that we need to take out to keep this momentum going. 10.02 on the downside before we start to reverse course potentially and set for lower territory. So as always, if you want help in your own grain marketing situation, visit us online at grainhedge.com. Take a demo of our trading platform. See what you get for only $7 trades. You get free cash bids from 4,000 different elevators to help you in your grain marketing situation. You get technical alerts to help you in your market timing, and you get our morning commentary with insights on things like Chinese hog margins to help you in your own grain marketing situation. That's all we've got for today. Join us tomorrow. We'll be talking about NOPA crush and EIA ethanol. Have a great day.